معرفة.
Bismillahir Rahmanir Rahim. Now let us discuss about Sukuk Al Mudaraba. Okay. Now what is Sukuk Al Mudaraba and what is the structure of Sukuk Al Mudaraba? Again, quickly, as we have discussed, in every Sukuk there is a company which wants to raise funds, and then these are investors. This is an SPV in the middle, and this is, for example, the project, and this is the capital. So let us start how the process would flow. That the investors would subscribe to the Sukuk and pay the capital or the funds to the SPV. The SPV, which is this, now would enter into a Mudarabah agreement with the company. So in a Mudarabah agreement, the SPV is the investor or the Rabbul Mal, and the Mudarib, which is the company. Meaning to say, the company is appointed as the manager to invest the capital of the investors in a project which is in the form of a restricted project, meaning to say that it is agreed in the Mudarabah agreement what would be the investment plan, in which area of business will the Mudarib invest, and what is the expected profit from the project which the Mudarib would be undertaking by using the proceeds of the investors. So a detailed plan would be agreed in the Mudarabah agreement between the SPV and the company in case of how the liquidity or how the funds would be invested. There is no contribution from the Mudarib. So the company does not make any contribution. The only contribution from the company is the contribution of effort, skill, and so on and so forth, and time. And the capital contribution is only from the investor or the Rabbul Mal. Mudarabah Sukuk, the principles of the Mudarabah would follow, meaning to say that in case of a loss, the loss would be borne only by the investor, provided, of course, there is no negligence from the company in terms of managing the project. The profit between the company and the SPV could be agreed through the Mudarabah agreement. So for example, if the profit ratio is agreed that it is 70:30, meaning to say that 70 should go to the investors and 30 should go to the company as a Mudarib, that could be agreed through a Mudarabah agreement. Generally, the main issue in a Mudarabah agreement which comes in a Sukuk is that at the end of the Sukuk, at the maturity of the Sukuk, a Mudarib is not permitted to provide an undertaking which agrees upon purchasing of the underlying Sukuk assets at a pre-agreed value. And that is the main problem why Mudarabah is not generally being used, because it is difficult from a Sharia perspective for a Mudarib to give such an undertaking, saying that, for example, after 5 years I would purchase the underlying assets of the Mudarabah Sukuk at this value. And this value meaning the face value of the Sukuk. So that is the reason why generally a Mudarabah Sukuk becomes in a way difficult in terms of having a very strict liability on the company to purchase the assets at a pre-agreed value. There is also another important thing in a Mudarabah Sukuk, and that is because in a Mudarabah Sukuk, for it to be tradable, or for that matter any Sukuk for it to be tradable, we have discussed that there has to be 1/3 of the assets of the Mudarabah or a Sukuk in a tangible form. So for example, if they are investing in a business and they are holding 90% of the proceeds as cash and only 10% of the cash is invested in certain business, then in such a case the tradability of Sukuk will be affected, because the Sukuk should have tangible assets behind it. It cannot have just cash. So why? Because we know that when a Sukuk has only cash and it is being traded, then whatever there is premium or discount, that will be considered as interest or riba. So it is important to note that in a Sukuk Al Mudaraba or in a Sukuk Al Musharaka, that there has to be at least 1/3 of the assets in the form of tangible assets in the Sukuk structure. So that is one of the important point which needs to be agreed in the Mudarabah agreement between the SPV and the company. So just to recap on the Sukuk Al Mudaraba, into a business plan which is agreed with the company, and generally this business plan also gives a certain expectation in terms of what is the expected profit or the outcome from the business venture in which the company would be investing. The company would not be held liable if the expected return is not achieved, provided we can prove that there has been negligence from the side of the company. Otherwise, the company should not be held liable in a Mudarabah Sukuk if there is no expected return attained from the business venture. In terms of the close out, generally what happens is that as in the other agreements, even in the Mudarabah Sukuk, we have seen that there is a sale undertaking given by the SPV, and then there is a purchase undertaking given by the company. So the purchase undertaking is triggered in case of maturity and default, and the sale undertaking is triggered in case of a tax event and a prepayment event. Generally, we have also seen recently that in case, for example, in Mudarabah Sukuk structures, on a periodic basis, when the profit is given to the Sukuk holders, there has to be a constructive liquidation of the Mudarabah. What we mean by a constructive liquidation is that what we do is that after, for example, if the periodic payment term is after every 6 months, so after every 6 months there is a calculation of how much profit has been generated through the Mudarabah, and after calculating that profit, so it means there is a constructive liquidation process which takes place in terms of calculating the profit generated through the investment, and that profit is being distributed through the SPV to the investors. At maturity or in case of default, there is actual liquidation of the assets. When we mean actual liquidation of the asset, what we mean is that the underlying assets are generally in a Sukuk structure purchased back, so meaning to say they are coming out of the Sukuk structure, so there's a complete liquidation of the Mudarabah, and then the proceeds are passed back to the Sukuk holders. And another important point which needs to be discussed in a Mudarabah Sukuk is that the Mudarib can give a liquidity facility, but this liquidity facility cannot be legally binding on the Mudarib. So it is generally the language which is used is that the Mudarib may give a liquidity facility in case if during the periodic distribution time the expected return is not generated. So this is another point which needs to be understood clearly in a Mudarabah Sukuk.